All right, hey everybody, it's Matt. So I've been wanting to cover this topic for a very long time, since before I started my firm in 2019. And this morning I received a link to a email or a link to an article from a client that brought this to light and really motivated me to make the video. So what is it that got my attention? So I was forwarded this article from Morgan Stanley, and it's by Lisa Shallett. It says, why investing in the S&P 500 isn't true diversification. And it goes on to talk about how there's a lot of concentration risk. If you think about the S&P 500 as having 500 stocks, you may be surprised to learn that a very small group of companies within the index actually make up a significant portion of the overall weight and returns of the index. So the top 10 mega companies, largest companies in the index, comprise about 35% of the market cap. And so, for infotainment purposes, it's, titled why it's not true diversification. And I'm not, Lisa Shallett is incredibly brilliant, and I don't mean that in a disrespectful way. What I'm doing right now is infotainment. Also, I'm trying to provide information, but, I'm not presenting an academic paper, and neither is she. But when I read this headline, I'm just kind of like, okay. Bespoke on Twitter also has a tweet about it this morning. And I think I'm recording this on Friday, May 26, 2 p.m. Central Time, 2023. So this is right before Memorial Day weekend. The markets have just hit a recent high during the intraday. And Bespoke is also pointing this out too. And so I think people are going to see this in the media, that when you look at the differential in returns between the market cap weighted S&P 500 index and the equal weighted S&P 500 index, the market cap weighted is outperforming the equal weighted by the widest margin since December of 1999. And when we look at these peaks, here's the tech bubble basically, here's really the middle of kind of the 08, 09 crisis. Here is a couple of months into the pandemic. And so you look at these dates and you're like, well, geez, this doesn't bode well for us. Typically when the largest companies in the index are outperforming the broad index by this much, it usually signals that things are going to turn south. So if you just heard me say all that, the market cap weighted S&P 500 and the S&P 500 equal weight, and that all sounded like gibberish to you, that's the point of this presentation. So that's what I am going to cover. How do indexes work? This is something that I will talk about in a little bit in terms of my career history, but suffice it to say, if you think about a person's kind of work history and knowledge and expertise, this is, I would say, a topic area where I go very, very, very deep, and it's super niche in terms of like a topic. And it's something I think is fascinating, and I think if you learn about it, you might find it interesting too. So if I want to measure the performance of 500 stocks, how do I do that? And it's important to understand that indexes are generally created and used to track performance. You'll see disclosures all the time when index performance is illustrated that says that you can't invest directly in an index. An index is just a theoretical grouping of securities. In this case, I'm going to be focusing on stocks as opposed to bonds or other types of securities. But it's just an index is just a theoretical grouping of securities. And like I said, stocks here that share some characteristics, and you get to define what those characteristics are. So for the purposes of the video, let's just start with two stocks in an index, right? I said 500 because that's reminiscent of the S&P 500, but for simplicity purposes, let's just take two stocks. We have huge company and we have little company. Huge company costs $80 per share. There are 1,000 shares that trade, and I'm choosing my words carefully there. Shares that don't trade are irrelevant for what we're doing. This company has $4 per share in profits and $4 per share in dividends. Then there's little company. Little company costs $20 per share. There are only 100 shares that trade as opposed to 1,000. Little company makes $5 in profits and it makes $3 in dividends. Now let's say that huge company has a return of positive 10%. So an $80 share price goes to $88. And little company has a share price decline of 10%. So $20 per share now becomes $18 per share. Overall, your portfolio has gone from $100 to $106 if we assume that you own one share of each company. Or maybe I should be saying the index owns one share of each company. So you have huge company and little company, one share at $80, one share at $20. So now you've got $100 in the index. When huge company increases 10% to 88 and little company declines 10% to 18, you're now at $106. Okay, so as I mentioned, indexes typically serve as a way to measure returns. And so the question is, well, how do we measure the returns of that index of two stocks? So I've replicated the stats up here, and I'm sorry it's squinched up, but we needed room down here. So the huge company, again, $80 per share price. There's 1,000 shares. It's making $4 in profits per share. It's making paying $4 in dividends per share, and it returned 10%. Little company costs $20 per share. There's 100 shares outstanding. There's 100 shares that trade, I should say. It generated $5 per share in profit. It paid $3 per share in dividends, and it had a 10% decline in price. So the first way we could think about measuring the return is we could just take a simple average. We could say, well, one of them returned positive 10%, the other one returned negative 10%, and so the average is they returned zero as a combined entity. That would be an equal weighted index where we don't care about the size of the companies, however we want to define size. We're not thinking about that, just we invest an equal amount in each company. One of them returned 10%, one of them declined negative 10%. And so on an equal weighted basis, if one's up 10, one's down 10, then overall the two of them are at zero. And that's a pretty simple, easy way to do it. You may intuitively just say, well, that doesn't feel right to me. That doesn't make a lot of sense. So method number 2 is a weighted average. And in the case of our example, I said that we'd bought one share of each of the stocks, or that the index owns one share of each of the stocks. And so when $80 of your $100 portfolio is in the huge company, well, its movement, its price return matters a lot more than the $20 of your $100 portfolio that declined 10%. So we just do a weighted average. You don't need to worry about the math, but at the end of the day, your portfolio went from $100 to $106, and you can see here it's a 6% return. And again, this is a function of owning one share per company. That is a price-weighted index. So we buy one share of each of the constituent companies, and that's how much the index is worth. So in our case, it's a two-stock index, $80 per share, $20 per share. The index value is $100. This one represents 80% of the weight. This one represents 20% of the weight, and it's just weighted by its price. And then there's method 3, which is cap weighted or market cap weighted, and that's what these recent articles are talking about, and where we'll spend some time talking today. And essentially what this is saying is, well, the price doesn't really tell us a lot about the size of the company. What tells us the size of the company, in this case, is the value of the company. So if huge company is $80 per share, and there are 1,000 shares that trade, then the value of the company is $80,000. If I wanted to go buy every single share that I could in the open market, it would cost me $80,000 to do so. And we're ignoring transaction costs, and we're ignoring the fact that if you try to buy every single share of a company, that the price itself would go up. We're just saying if somehow you could flip a switch and you wanted to buy all 1,000 shares at $80, the value of the company is $80,000. Well, what's the value of the little company? It's $20 per share, and there's only 100 shares that trade. So you could buy this stock for $2,000. You could buy this company for $2,000. So huge company costs you $80,000 to buy in its entirety. Little company costs you $2,000 to buy in its entirety. And so in this case, the return, if we wanted to allocate to these stocks by their relative market value, which is market capitalization is another way to say that, then the return would be 9.5% in this scenario, because 80,000 of the 82,000 in market value is all comprised of huge company, and huge company had a 10% return. Only $2,000 of the combined 82,000 in value is owned by little company or represented by little company. So its negative 10% return didn't have that much of an impact. This is what's called a market cap weighted index. And you could imagine applying this across like 500 stocks, 1,000 stocks, whatever it may be. So some examples of these: method one, an equal weight index. The example would be the S&P 500 equal weight index. There's an ETF where the ticker is RSP, like Robert Smith portfolio. And that's what they were referring to in the article, in the bespoke tweet. Method two, where you do a weighted average or a price weighted index. That's the Dow Jones Industrial Average. The Dow Jones Industrial Average is a long existing index. And back in the day, they just said, well, look, we're going to buy one share of each stock, and that's going to determine how much of each stock we own. So if a stock were $300 per share and another one was $10 per share, they're going to put the most weight on the one that's $300 per share as opposed to $10 per share. It's a super simplistic way to go about doing things. It just pretends that you buy one share of each stock. And there's no really, I wouldn't say there's any kind of fundamental research that backs that up as a good methodology. But it's simple and straightforward, and it was started a very long time ago. Then method three, the cap-weighted indexes. That example would be the S&P 500 and many, many other indexes. I believe that the vast majority of indexes in existence are market cap-weighted. Example of this would be IVV, like Indigo Victor Victor. That's the iShares S&P 500 ETF that I use for clients when they need exposure to the S&P 500. And I forgot to mention that DIA, David Indigo Alpha, is one of the ETFs or an ETF that tracks the Dow Jones Industrial Average. Okay. So the next question is, why though? And I found an opportunity, you might say I shoehorned an opportunity into the presentation to use this meme that I just absolutely love. So there you go. I think it's hilarious. But if you're saying, well, why are so many indexes weighted by market capitalization? What's the point? Well, the answer is it's because of the efficient market hypothesis. And it's also because we're measuring the return of a broad market. And so if you think about it, if I want to know what was the return of the U.S. stock market on any given day, I probably care, it probably matters a lot more what the return was of the very large companies in the United States versus the much smaller companies in the United States. But there are other ways to do it. And I spent the 8 years of my career prior to opening this company trying to spread the gospel of some of these other ways of creating indexes. One way that you could think about is weighting indexes and their constituents by their profits. So in the case of huge company, I think I must have gotten rid of their stats. I'll see if I can put them back quickly. Yeah. In the case of huge company, if we look at the relative share of profits, Huge was making $4 per share in profits on 1,000 shares. So it was making $4,000 in profits. Little company was making $5 in profits, but that's across 100 shares, so 500 shares. So when we put the overall portfolio together, Huge is 89% of the profits, but it's 98% of the market cap, or the value of the combined companies. So in a profit weighting scheme, we would look at it and we'd say, well, Huge grew to be 98% of the weight of the portfolio because it increased by 10% while the little company declined by 10%. And normal indexing would just leave it there. Normal market cap weighted indexing would just leave it there and say it should be 98% of the weight of the index. Using profit weighting, we take an extra step and we say, well, did their share of profits increase? And so the $4,000 in profits as a percentage of the $4,500 in profits did not change in my example. And so because of that, we would sell off some of Huge and rebalance it back down to its 89% weighting that it started at. And it's a way to do kind of a relative value rebalance. We understand that the price went up, but was that price increase justified by a profit increase relative to the peers in the rest of the index? If the answer is no, we rebalance down to 89%. And then in terms of dividends, Huge is 93% of the dividend payout. So here we're paying $4,000 in total dividends versus $300 in total dividends from little company, right? $4 per share times 1,000 shares, $3 per share times 100 shares. So Huge is 93% of the dividends paid by these two stocks, but it's 98% of the market cap, just like always. And so in this methodology, we'd say, well, the price increased by 10%, and therefore the cap weighting went all the way up to 98% of the index just because the price moved up. But the dividends did not increase to justify that relative increase in weighting. And so we'd say maybe the price went up for reasons that were not fundamental, whether it was not based on profits or not based on dividends or not based on, 100 other different metrics that we could look at. We would say this wasn't justified. And so we're going to take some of the profits away and sell some of it off and rebalance it back down to 93% because that is its relative share of dividend payments between the two stocks. So if you see this style of indexing out in the wild, it'll come by many names. Some of the most common names are either fundamental indexing because they are looking at what are perceived to be the fundamental characteristics of the companies, profits, dividends, could be revenues, could be sales. It could be a lot of different things. You might also hear it referred to as smart beta. Beta is a sort of industry jargon for market cap weighting, and this is considered, or let me rephrase that. This has been promoted by some people as being a smarter way to do it because we're still scaling for the size of the company because we're looking at the profits times the number of shares in existence or the dividends times the number of shares in existence. So we're still scaling for the size of the company, but instead of using price as the main metric for the company's value or relative value, we're using profits or dividends. And so some people started coining smart beta. I can tell you those of us that were in the industry trying to market this to advisors as a better way to index, we really hated that term because, of course, as soon as it doesn't work, now it's dumb beta or whatever the term may be. So you may hear it referred to that way. We typically didn't like to use it. And then in terms of its attributes, if you think about it, this is typically like a value style strategy where we're taking away we're taking our profits if the determination is that the stock price increase was not justified by some fundamental metric. So we're typically rebalancing and selling off things that have had momentum in their price for whatever the unjustified reason may be. So it's typically a value strategy and or anti-momentum. This is MOM. I was running out of space over here. So these are anti-momentum strategies. You're not continuing to bet on what is going up unless it has to be justified. So the price increase of the stock has to be justified by profit increases or dividend increases relative to the other companies in the index. Okay, so let's look at a real life example. I was using super simple math and prices and all that sort of stuff, but let's look at real life numbers. Apple stock. When I was doing this, it was about $175 per share. there were 15.7 billion shares outstanding that trade. And so when we multiply those two numbers, we get a $2.7 trillion market value. Again, market capitalization is just a fancy way of saying what is the overall value of the company based on its stock price. And so that $2.7 trillion market cap, or value for the company, represented 7.23% of the weight of all 500 stocks in the S&P 500. So intuitively, if you think about an index that says it holds 500 stocks, if you ever even thought about it, you might think that each stock gets 1/500th weight or allocation of your dollars. That would be equal weighting, and that is generally not true. There is the index and there is an ETF that does that, but what is, much more mainstream popular is the market cap weighted index version. So let's flip over and look at this in real life. So I realize not everything is on the screen. Let me see if I can zoom out just a little bit. Okay, so what I'm looking at are the holdings of IVV, Indigo Victor Victor. This is the iShares S&P 500 ETF that I use for my clients. These are the holdings as of May 25th, 2023. You can see these holdings over here on the left, a bunch of information. And then what I want to bring to your attention is the weight column. So you can see at that time, Apple was 7.39% of the weight, Microsoft 6.97%, so on and so forth. And so Lisa Shallot's point in doing this was saying, hey, look, if we add up the top 10 constituents of the S&P 500 index, that represents 30% of the weight of the entire index. So said another way, the remaining 490 stocks only represent 70% of the weight of the index. And so this is significant concentration. It is unusual, as you saw in the chart. And the performance of just a handful of these stocks this year has really carried the performance of the overall index itself. So you can easily be misled to think that broad U.S. stocks are doing well so far in 2023, because you'll hear a quote that the S&P 500 is up 10%. It's hitting a near-term high today, right now, as far as I know. I haven't looked at the trading in the last 30 minutes, but you might hear that and you might think, man, things are really looking well. The largest 500 companies in the U.S. are going gangbusters and up 10%, and this is great. But the reality is that a very significant portion of that return is comprised of just a handful of these stocks here, the largest stocks, and the rest of the basket, or the rest of the index, is actually not doing that great. I think it's up about 1% on average if we remove the highest performers. So I just kind of want to illustrate that for you, that these just these alone combine to 30% of the weight, and it's only 10 out of 500 holdings. The other thing I want to point out, and I hope this doesn't get confusing, I want you to see that these stocks can trade on different exchanges. So an exchange is like a marketplace. It is the grocery store that you go to get your groceries. So when that is different than an index, although sometimes they will have an index based on what exchange. So they might have an index of NASDAQ stocks. They do have an index of NASDAQ stocks. They can have an index of New York Stock Exchange stocks. But that's not what this is. This index is generally described or attempting to be representative of the largest 500 companies, profitable companies in the United States. That's not technically the way the rules are written, but for simplicity's sake, let's just think about the S&P 500 as the largest profitable companies in the United States, largest 500. They may trade on different exchanges. So if you, as an investor, were to own an S&P 500 ETF and have all 500 of these constituent stocks, and then you were to go look and say, wow, the NASDAQ has really outperformed, the stocks on the NASDAQ exchange have really outperformed over the last 10 years. I'm going to diversify by owning NASDAQ listed stocks. Well, what you're really doing is doubling up on all this stuff. Many of the stocks that trade on the NASDAQ are also in the S&P 500. So you would buy Apple via your S&P 500 ETF, you would also buy Apple via your NASDAQ ETF. And I will come back to this later, but suffice it to say that you really need to be aware of that kind of overlap and additional risk, because if Apple represents 7.39% of the S&P 500, what does it represent within the NASDAQ? And I should have that pulled up. Here, sorry. Invesco QQQ. This is a NASDAQ tracking ETF. And within the QQQ ETF, Apple represents 12.23% of the weight. So this is even more concentrated. And many of these names, Microsoft, Apple, a lot of this stuff you'll see held here in the Qs, as they are referred to, QQQ. You'll see them here, and you'll also see them in the S&P 500. And so when you have what I call naive diversification, you really run a risk of creating overlap and gaps in your portfolio. I realized when I switch over to here that I had intended to bring this up when I talked about the efficient market hypothesis. If you're interested in the academic stuff, I said that market cap weighting is based on the efficient market hypothesis, and I didn't say anything else about it. I'm not going to spend a bunch of time going through it, but you can go to Wikipedia and look it up. And essentially, it is a hypothesis that says that all available information is used by rational investors, and all investors have equal information and access and always act in their best interest. And essentially, that you're not going to beat the market, that the market in its large sort of wisdom, like so many different market participants analyzing relevant available information that's immediately available to everybody, means that whatever the price is of the given stock is going to be the accurate, correct price reflective of the true value of the stock. And that's sort of my non-official, hopefully not screwed up too much, definition of the efficient market hypothesis. There's a strong form, there's a weak form. You can go through and look at it. I would say, and I've written this in a blog, that I'm not a huge proponent. I don't think markets are efficient all of the time, and I think, in fact, that markets can be inefficient for extended periods of time. The efficient market hypothesis has a lot to do also with modern portfolio theory and the way to build an appropriate portfolio where we're adjusting to try and get the highest amount of return per unit of risk, or minimize risk per unit of return, however you want to think about it. And this led to kind of Nobel Prize winning research, or was Nobel Prize winning research. And you will see it referred to in marketing collateral a lot. You'll see the term evidence-based investing, that references a lot of this stuff, high academic theory, and you'll see a lot of advisors and salespeople quoting it and referencing it and all that. Obviously the people that are winning Nobel Prizes are smarter than I am, but I would say that just beware of when academic theory gets transferred over into products that are sold to you. And anyway, I think I'll stop with that because I don't want to start a war. But just be aware, if you're interested in modern portfolio theory and or the efficient market hypothesis, you can go look at these things. Wikipedia has great information on them, and the efficient market hypothesis has a lot to do with why index creators typically weight their constituents by market capitalization. Okay, so given everything that I just said, it might sound like I am not a huge fan of the efficient market hypothesis or market cap weighting, and that's not really actually true, although I understand that my tone probably sounded a little bit irreverent. But the question is, what do we do based on this information? I would say, I would ask the question, do we pay extra for the potential for outperformance, or do we pay extra for higher risk-adjusted returns? Meaning, so far, everything I've talked about has been theoretical in nature. Is there a better way to create an index instead of weighting or allocating to the underlying constituents based on the value of the companies? Should we allocate to them based on profits? Should we allocate based on dividends? Should we allocate based on some other fundamental metric. And I think it all sounds very intuitive. I was extremely motivated to go spread the word on these alternative weighting strategies. I still do believe intuitively that being in a situation like we are right now, where the top 10 holdings of a 500 stock index represent 30% of the weight, is overdone and probably not ideal, and probably an example of the market being inefficient. I would think that there's a high likelihood that those stocks, if not all of them, some of them are overvalued and will come down. And because they're such a large weight in the index, then those index holders, the ETF investors, including myself, will suffer for that and have kind of a larger allocation to those than maybe we would based on fundamentals. So the question is, do we pay extra for the potential for outperformance, to not have those kind of weights occur? And or risk-adjusted returns? And it's a tough question. What I'm doing here is I'm comparing, now this is my alma mater, Wisdom Tree is where I worked for 8 years when I was spreading this gospel of these different weightings. And you can see I've pulled up the Earnings 500 ETF, which might be considered sort of the proxy for the S&P 500, but weighted by profits. And the U.S. Large Cap Dividend ETF, which may be considered a proxy for U.S. large cap stocks. But dividend-paying stocks only, which most large-cap U.S. companies, like most of the S&P 500 stocks, pay a dividend in the first place. But these are dividend-weighted and earnings-weighted U.S. large caps, let's say. And then I've compared it to IVV, which I've kept referencing, the iShares S&P 500 ETF that I use for clients. And the question is, okay, well, like over the last 10 years, that fundamental weighting hasn't worked out in aggregate. The S&P 500 has returned 203% cumulative, while the earnings-weighted ETF and the dividend-weighted ETF have not kept up with that. And you could own the S&P 500 ETF, the winner, for 0.03%, 3 basis points per year, or you could pay 28 basis points to own the dividend-weighted, or you could currently pay 8 basis points to own the earnings-weighted version of it. And when I was with Wisdom Tree, this cost was higher. I believe it was 28 basis points, just like DLN. And so that's when we get into real-life questions about, well, philosophically, I think it makes more sense to rebalance indexes on a periodic basis relevant to their earnings, relevant to their dividends, some fundamental metric that goes beyond just the price of the company, because we all know that there can be short-term blips in prices. Frankly, they can even last for years based on rumors or projections or all this kind of stuff. But dividends and earnings are more kind of fundamental characteristics of the company. So intuitively, philosophically, I like those ideas, but you do have to pay up for it, at least in the case of these ETFs. And it can go for a long time without, I'm using air quotes, without working. And would you, as a client or investor, stick around for that? Would you be okay with paying extra for this for the opportunity to outperform? But who's to say you will? So that's a 10-year time period, 15-year time period is similar. Going back to, I believe it is February 24th of 2007, when the earnings index starts, earnings almost matches the S&P 500. So the earnings weighting had 293% cumulative return. The S&P 500 had 294% cumulative return. These are net of expenses. So keep that in mind. So you don't need to do, if you deduct the expenses again, then you are double counting the expenses. You don't need to do that. So you might say, well, gee, you pretty much broke even on it. Is that enough reason to flip over and to try it going forward? I don't know. I lean towards not. And the other thing I need to point out about this is risk adjusted, because that's another thing I mentioned. Do we pay up these higher fees to have higher risk adjusted returns if we're not going to get higher absolute returns? And in the case of the dividend version, Sharpe ratio is a measure of risk-adjusted returns. And so even though the dividend-weighted index did not keep up with the other two, it did have a better per unit of risk return. So like for every unit of risk that we took on, it actually had the highest return per unit of risk. But in absolute return terms, which is what we eat, then it just didn't keep up. So, it's a really hard choice to make. And I'm just debating whether I want to keep going down. I mean, one of the things I could point out is this is showing drawdown over the same time period of these various funds. And you can see that in the most recent crisis that the dividend-weighted index, or the dividend-weighted ETF, I should say, didn't experience the same drawdown. And that is an example of having a lower downside capture than the other two. So it captured, let's say, 78% of the downside, whereas the earnings-weighted index captured 96% of the downside. And of course, the benchmark is the S&P 500 ETF over here, so it captured 100% of the downside by definition. I would look at this and say these are actually really great characteristics. When compared to the S&P 500, dividend weighting, you got more upside capture. You captured 86% of the upside and only 78% of the downside. Earnings weighting, you captured 97% of the upside and only 96% of the downside. So those are favorable characteristics. And on a risk-adjusted return basis, the dividend weighting certainly looks attractive, and the earnings weighting looks as attractive as the S&P 500. But again, I keep coming back to, we don't eat risk-adjusted returns, right? At the end of the day, if you started investing in the dividend weighting index, it's nice that you got better risk-adjusted returns, but the reality is cumulatively it only returned 220, 221%, whereas the other options return 290% plus. And so that brings me back to, what do we do about it? My answer is that maybe we use it, but probably not. We can if you're a true believer. I mean, I frankly was, and I guess still am, a little bit of a true believer in this, that I think there are better ways to index. But I have to acknowledge that it's very hard for an investor, an advisor, for anybody to stick around and remain a true believer in a strategy when it frankly just doesn't keep up over those kinds of long periods of time. Even if we're right, so to speak, I mean, 10, 15-year time periods, that could be somebody's entire retirement, And so the other thing I think I meant to show on this is, well, why was this the case? And remember how I said these strategies are anti-momentum? Well, one of the things that did so well for most of the time, you see it collapse down here at the end, but for most of this time period, momentum as sort of a factor of returns did really well. So again, if we go back to the 10-year period, you could see momentum outperformed by a long shot for a significant period of time. And that means that these stocks, the ones that are doing well from a price return perspective, are continuing to do well. That adding to them is actually benefiting you as opposed to rebalancing. Whereas strategies like rebalancing according to fundamentals, like dividends or earnings, they're taking away from this unjustified momentum where earnings haven't justified the increase in price or dividends haven't justified the increase in price. Now, obviously you saw momentum has collapsed since 2022, and that's why momentum style funds have also collapsed and really taken a bath. But in principle, I think you get what I'm saying. Okay, I'm going to pause one more time. Hopefully, only one more. All right, so it was suggested to me that when I make these like Opus videos and emails and things, that maybe I include an Easter egg, for those that make it to the end. So this isn't, I guess, technically not an Easter egg, but it is a fun fact. So what I want to express to you that will make you the smartest person in the room when you're talking to friends, family, know-it-alls about investing, including advisors that are, or salespeople, I should say, that are posing as actual investment advisors. Mixing index families is a bad idea, and the brands that you use don't matter as much as you think they do. So like Vanguard is a brand, iShares is a brand, Charles Schwab is a brand. A lot of people base their investment decisions for which funds they're going to use on the brand. And that is really not a wise idea. What you really should care about is what is the index that the investment is tracking, or at least benchmark to in the case of actively managed mutual funds. So some of you may be aware I run as a side business to my primary business of financial planning for clients, individual clients and families. I run a side business where other financial advisors, other registered investment advisors, fiduciaries can hire me on an hourly basis for consulting. And it's on my website, but it's hidden. You can't get to it through the normal through the normal navigation menu. It's not over here anywhere. You just have to actually type in the URL, so concertplanning.com/advisors. And I call it investment operations. I'm not giving these advisors nor their clients like fiduciary investment advice. I'm just helping with processes and fleshing out sort of philosophies and things like that. So Concert Investment Operations. And one of the very first things that I do with these clients, with these advisor clients when they hire me, is I walk them through this PDF. Now, this is zoomed in just because only portion of my screen is showing. So I'm going to zoom back in and try and kind of illustrate what it is you're looking at. This is from Vanguard, and it is an amazing, awesome, super useful graphic that shows the breakdown of the U.S. stock market based on which index family or index provider that we're talking about. So I've been focused on the S&P 500. S&P 500 is provided by S&P Dow Jones Indices, SPDJI. So the components of the S&P indexes illustrated here are the S&P 500, the S&P Mid Cap 400, and the S&P Small Cap 600. So when you add these numbers up, you get 1,500 stocks that represent the S&P 1500 composite index for broad U.S. market exposure. And what you're seeing on the left-hand side is the number of stocks contained in each index. So the S&P 500 index, it stops down here at this line, number 500. Then the next 400 stocks. So we're starting with the largest stocks at the top. And then as we go down, we're getting to smaller companies. Okay? So the top 500 stocks out of what they're showing here could be up to 4,000 stocks. The largest 500 represent 83% of the overall market cap, or the overall market value. This is why when people say the S&P 500 is a U.S. stock market, I take exception to that because it's a lot of the U.S. stock market, but it's not all of it. It's 500 stocks out of approximately, between 3,500 and 4,000 stocks, depending on who's counting. Each one of these providers is counting in a different way. It's only 500 stocks out of, call it, 3,000, 4,000 stocks. It's only 83% of the market cap. That's a lot, but that's not all of it. And so in order to get more of the market cap, you could do something like put the S&P completion index on it. There's a Vanguard ETF for that, VXF, and it represents the next 17% of the market cap and supposedly gets down to covering nearly 4,000 stocks when you combine these two indexes together. I personally, in my portfolio, use the S&P 500, the S&P Mid Cap 400, and the S&P Small Cap 600. So I don't use the Vanguard funds normally. These are the ticker symbols for those funds. I use iShares. But the point is, the brand, whether it's Vanguard or iShares, doesn't matter as the first priority. The first priority is deciding which family of indexes we're going to go with. So when I'm using S&P 500 indexes, I'm getting 83% of the market there, another 6% here, and another 3% here. So I'm getting about 92% of the market. And it would be fair to say, hey, you're missing 8% of the market. And yeah, I get that. I'd rather have the flexibility of owning 3 funds instead of 2 when it comes to needing to sell for tax loss harvesting reasons, or liquidity reasons, or rebalancing, or whatever it might be. But yeah, those are the S&P 500, those are the S&P family of indexes. Then you have CRSP. Vanguard has funds that track CRSP indexes, so you could get the CRSP U.S. total stock market. through VTI. This is a very popular ETF. It covers 99% of the U.S. market. You can see it contains more than 3,500 stocks. Or you could break this up into component parts. You could own the CRSP U.S. large cap segment, which is 87% of the market cap. You could own the CRSP U.S. small cap index to get the next 12% of the market cap. And notice that these are also totaling to 99% of the market cap, and yet you're missing like 1,500 stocks between VTI, the total market, versus using the large and the small components. And that just goes to show that all these stocks down here that are missing are really a rounding error in the whole calculation, which is another reason I'm not too worried about, in my world, not having all these stocks down here. And then you could even break up the CRSP U.S. large cap index into the mega cap component here, and then the U.S. mid cap index. And I'll tell you, one of the things I see all the time from advisors that come to me and other, clients, investors, whatever, people that have Vanguard branded ETFs in their portfolios, is there might be a mix of CRSP U.S. large cap index, CRSP U.S. mid cap index, and CRSP U.S. small cap index. Well, what are we seeing? We're seeing that when you combine the U.S. large cap version and the mid cap version, you're doubling up on all these stocks right here. Most of the CRSP U.S. mid cap index is contained within the U.S. large cap index, and the stuff that isn't is already contained in the small cap index. So if you are going to own these two or any one of them and combine it with a mid cap, you're actually doubling up on all these mid cap stocks. And so, as I referenced earlier in a previous screen, this is what I would call naive diversification, and people are just buying things based on the names. They think, well, I have the large and I have the small, and therefore now I need the mid. Well, that is not true. You are doubling up on all these stocks if you do that. And then finally, Russell indexes. So Russell indexes over here on the right, once again, you've got the Russell 3000. It covers 99% of the investable market cap with around 3,000 stocks, as in the name. And the Russell 3000 can be broken down into components, the Russell 1000 and the Russell 2000 small cap. And so it's just such a great example of different index families. They all have different methodologies. Russell does not require profitability before a stock is included in the indexes. And so that's why you have, when Russell is trying to get small cap exposure, their methodology has the Russell 2000, like 2,000 constituents. S&P requires profitability before adding a stock to their index. And therefore, when we look at the small cap universe, that's why their small cap is only 600. Ask your advisor or ask, the know-it-all friend that's telling you they know everything about investing, why is the Russell 2000 different than the S&P 600 for small cap? The answer is profits. Sorry about that. Market just closed. The answer is largely profits. It's the screening requirements for stocks to become a part of the index. And so, again, you'll see naive diversification where somebody might own the S&P 500 for large cap, and then they will own the Russell 2000 for small cap. And there's this gap of space. They're not going to hold the same constituents. They're going to have different methodologies for how they determine what is components of each of their indexes, and you're likely going to miss a swath of the mid-sized companies in the United States. And you'll also see this in media quotes. Media often quotes the S&P 500 for U.S. large cap and or total U.S. market, and then they'll quote the Russell 2000 for U.S. small cap. But these are two different methodologies and things. And so it's really important for you to have a philosophy and an understanding of which index family do you want to track in the first place. And only at that point do you go and choose which brand do you want to use to implement the index. As you can see with Vanguard, if you like CRSP, you can use Vanguard. If you like S&P, you can use Vanguard. And if you like Russell, you can use Vanguard. I believe Vanguard is the only brand that tracks CRSP. But S&P, you can get it a lot of places. You can get it Vanguard, iShares, State Street, other places. Russell, I think, are tracked by multiple brands. And so this should really be your first priority. And then the second priority is choosing the brand that you're gonna use to track these indexes. And that's where you start looking at cost. What is the relative cost of the Vanguard version versus the iShares version versus the State Street Spider version, so on and so forth. The other example of this that I wanted to show you to bring it to light, I've been focusing on U.S. indexes. I think it's really interesting to look at international indexes as well. This is the example I use with advisors all the time. If I look at the iShares MSCI Emerging Markets ETF, MSCI is the index provider. So MSCI, how do they define emerging markets? Their emerging markets ETF, I want you to see, it has 12, almost 13% allocation to South Korea. Well, what if I combined the iShares Emerging Markets ETF with the Vanguard Developed Markets ETF? Because after all, I want both developed markets and emerging markets in my international stocks. But I'm going to have naive diversification. I'm going to use iShares for one of them, Vanguard for the other, because, hey, different brands, now I'm diversified. Well, the problem is now the Vanguard fund tracks FTSE. So Vanguard doesn't offer MSCI. So if I were to continue scrolling down here, we would get to international exposure. Vanguard tracks FTSE. Sorry. Vanguard does not have ETF products that track MSCI indexes. So you have to decide, if I want Vanguard, I have to select FTSE. So going back to the example, let's say I'm using iShares for emerging markets because it's a different brand, and I have nearly 13% allocated to Korea. Then I have Vanguard for developed markets, and I've got 4% allocated to Korea. The reason I'm pointing this out is because the two different index providers categorize Korea differently. This is South Korea. It says Korea, it's South Korea. FTSE considers Korea to be a developed market country because its economy is considered to be a developed economy. MSCI considers Korea to be an emerging market because, yes, it has a developed market sort of economy, but it is sitting next to North Korea with an unbelievable amount of geopolitical tensions that really make its risk profile, in my opinion, similar to an emerging market country as opposed to a developed market country like France or whatever. So you need to think about, like, what is my philosophy here? Do I believe that Korea represents the type of risk that I would associate with a developed market or with an emerging market? My personal choice is I believe that it represents a risk that's more akin to an emerging market, and so I'd rather it be in the emerging market bucket. And so what that means is that I need to track MSCI indexes for my international exposure. I need to track MSCI Emerging Markets ETF as well as MSCI Developed Markets. And those are both through iShares, at least for me. I use iShares for both of those. And like at the end of the day, you might be watching this and rolling your eyes and thinking, look, you're telling me I might double up on my South Korea exposure. In one fund, it represents 12%. In the other fund, it represents 4%. And we're talking about my international allocation, so that's really not going to be a huge allocation, most likely. Does this really matter? And I would say, yeah, probably it's not going to make or break your wealth and your well-being. I totally agree with that. But I think you should also, I think the person advising you on how to invest should know this. And it's why it's one of the first things I bring to the attention of the investment advisor clients that hire me for consulting, because it points out the larger issue of you need to know what you own. You need to know why you own it. And it makes the case for selecting an index provider first and then selecting the brand next, because it reduces, in doing so, you're going to reduce the amount of overlap in your portfolio, and you're going to reduce the amount of gaps in terms of the underlying holdings in your portfolio. And Korea is just the example I use, but this applies to individual stocks, it applies to sectors, it applies to geography around the world. So what I'm saying here is that in constructing a portfolio, you want to minimize overlap and gaps among the underlying holdings, the sectors, and the geography. Pick an index family first that you like, whatever your philosophy is. I personally go with S&P in the US, MSCI in international, and Bloomberg indexes for fixed income. And then look for the brand that offers that exposure at a good price. And if you do that, I am telling you, you're going to be ahead of 95%, I'm making that number up. You're going to be ahead of a very, very significant portion of investors out there, including professional financial advisors, because typically what people do is they say, I like Vanguard, or I like iShares, or I like American funds, whatever it is they like. They're focused on the brand and they don't really understand what they actually hold and what all the underlying gaps and overlap in the portfolios are. And that's really not the way to go about doing that. So, fun fact, if you're creating your own portfolio and or some salesperson is pretending like they're an advisor and telling you how to invest, ask them what they use, which indexes do they track. If they give you a brand name, then that's a big red flag. Vanguard is not an index. iShares is not an index, so on and so forth. DFA is not an index. It's a brand. And if they give you an answer like that, number one, that's a huge red flag. But number two, if you look at it and you say, well, gosh, you're using Vanguard in some places, iShares in other places, and they're going to say, well, that's for diversification purposes. I would look at stuff like this and say, well, what kind of gaps or overlap are being created because we're mixing and matching different index providers. These funds are going to hold different things and have different methodologies for selecting their stocks. And that's not diversification. That is naive diversification. All right. That's the end of it. So thank you if you stuck with me. I hope it was useful. And let me know if you have any questions.